The math doesn't add up. If you look at the engineering, the green energy transition is messy, expensive, and physically unreliable. Intermittent output, fragile grids, endless backup requirements. But if you look at the balance sheets of the world's largest asset managers, it looks like a gold rush. So here's the question nobody asks directly. Why is capital pouring into a system that produces less reliable electricity? Because Wall Street isn't buying electrons. It's buying contracts. The wind doesn't need to blow. The sun doesn't need to shine. The paperwork just needs to be signed. That's the real contradiction. If this transition were only about energy, it would already look like a failure. If it's about finance, it suddenly makes perfect sense. This video isn't about ideology. It's about incentives, because energy didn't just turn green. It turned financial. Part 1. From diesel engines to derivatives. Old energy was ugly, but honest. Coal plants, gas plants, nuclear reactors. They were loud, dirty, politically inconvenient. But they had one virtue. If you fed them fuel, they worked. Old energy was a physical system, like an old diesel engine, crude, inefficient, but predictable. That predictability shaped the business model. Utilities lived on stability. Oil and gas lived on decline curves. Investors priced the sector like infrastructure plus commodity risk. Now look at the new system. Wind doesn't run when demand peaks. Solar shuts down exactly when the grid needs power most. Output depends on weather, location, and timing. From an engineering perspective, this is a downgrade. So why does finance love it? Because renewables aren't sold as machines, they're sold as financial products. Old energy was about hardware. New energy is about structure. In the old world, the asset was the plant. In the new world, the asset is the legal wrapper around the plant. Energy as infrastructure cares about reliability. Energy as an asset cares about bankability. And bankability means one thing. Can the risk be priced, shifted, and sold? Part 2. Why capital loves unreliable power. Finance hates instability. But it hates uncertainty even more. Renewables have unstable output. But policy removes uncertainty. That combination is powerful. Here's how it works. First, guaranteed buyers. Long-term power purchase agreements. Utilities, data centers, governments locking in demand for 15 to 25 years. Second, price floors. Feed-in tariffs. Contracts for difference. Tax credits that behave like revenue. Third, carbon policy. Not everywhere. Not perfectly, but enough to tilt the risk map. And fourth, institutional hunger. Pension funds. Insurers. Sovereign funds. They don't want innovation. They want long-duration cash flows wrapped in regulation. So you get a strange outcome. A project that looks mediocre as an engineering asset can look excellent as a cash flow instrument. The weather is messy. The paperwork is beautiful. And one more detail most people miss. In many markets, the cost of capital matters more than the cost of hardware. If policy lowers perceived risk, financing gets cheaper. Cheaper financing turns average projects into good deals. So when people ask why money keeps flowing into unreliable energy, the calm answer is simple. Capital isn't buying reliability. It's buying policy-shaped risk. Part 3. Subsidies are not charity. The word subsidy triggers emotion, so let's treat it like an accountant would. A subsidy is not free money. It's risk transfer. It moves downside risk from private balance sheets to public ones. Here's the uncomfortable truth. So-called green subsidies are not generosity. They are surrender letters. Governments are saying, please invest. If it fails, taxpayers absorb the loss. If it works, you keep the upside. That's not ideology. That's de-risking. Subsidies create floors, under revenue, under demand, under returns. And here's the key asymmetry. Public balance sheets absorb long-term risk. Private capital still captures short-term gains. That's not corruption. That's the default structure of public-private finance. Governments can tax. They can borrow indefinitely. They can spread losses across society. Funds cannot. So policy becomes a financial instrument, a credit enhancement, an insurance wrapper. Some projects look unprofitable on paper until you count eligibility. Eligibility for tax credits. Eligibility for mandates. Eligibility for green capital pools. The project isn't just selling energy, it's selling access. Part 4. Energy companies became flippers. Modern energy companies don't behave like utilities. They behave like asset traders. They acquire land, secure permits, lock contracts, start construction, then they sell. This is asset recycling. They're not optimizing for 30 years of electrons. They're optimizing for financial close. It's real estate logic, like flipping houses. You don't care if the wiring lasts 40 years. You care if it sells this quarter. Projects get bundled, packaged, sold to funds desperate for green exposure. Energy giants aren't just producing power anymore. They're producing financeable assets. The scoreboard change. Success isn't grid stability, it's access to cheap capital. And here's the sharp part. A company can look successful while the system feels fragile. Because markets reward returns, not resilience. Part 5. You are paying the interest. Now let's bring this back to you. This is why your energy bill keeps rising even as solar panels get cheaper. You're not paying for electricity. You're paying for capital, for financing costs, for risk premiums, for policy insurance. The system is optimizing for balance sheets, not wall sockets. That's why things feel off. Costs show up in strange places. Volatility feels permanent. Infrastructure feels half-built. This isn't chaos, it's alignment. The system is doing exactly what incentives reward. That's how capital reshapes systems. So here's the structural takeaway. The energy transition isn't failing, it's succeeding at a different objective. It's succeeding as a capital coordination project, as a risk remapping exercise, as a way to move trillions under policy cover. Once you see that, the confusion fades. The real question isn't whether green energy will win. The question is this: in a world where energy is priced like policy-backed finance, who pays when physics refuses to cooperate? Stay curious, stay sharp.